there's a lot of misconception about the tax liabilities, especially if you're leaving Canada to the US or to at least, Middle East countries. People don't really realize, how much tax liabilities they have while they're leaving Canada, and they get a sticker shock when they receive the bill from CRA afterwards. I understand there's a lot of economic challenges in Canada right now.
I mean, if you have no ties with Canada, no citizenship, no residence, nothing, somehow you happen to be in this country physically, with some exceptions, for 183 days, you are tax resident of Canada. Staying more than 183 days does make you tax resident for that year, but if you are a citizen or a PR holder, and just because of the fact that you stayed less than 183 days, doesn't make you non-resident. So yes, one side is true. If you remain there, you are a resident, no matter your legal status.
All right, everybody, thank you very much for joining again our podcast with one of the tax consultant in the. Actually, he's based out of Canada, but he works across the country as well as, and also he deals with the international transfers. So, what we would like to discuss here is there's a lot of misconception about the tax liabilities, especially if you're leaving Canada to the US or to at least Middle East countries. People don't really realize how much tax liabilities they have while they're leaving Canada, and they get a sticker shock when they receive the bill from CRA afterwards. So we would like to take a deep dive into these topics, especially for people who are leaving Canada, because I understand there's a lot of economic challenges in Canada right now. The unemployment is almost hitting 7.1%. The challenges with regards to inflation and, of course, the lack of job opportunities here in Canada, which is pushing people away from Canada. And we would like to touch upon that, if you are willing to leave Canada or you are in process of leaving Canada, you should know your tax liabilities before you leave Canada. So for that, I have invited one of my friend, and he's one of the major consultant in Canada, deals with the tax related matters. So Aamir, thank you very much for joining our podcast. Please introduce yourself to the audience so that they know exactly, what your expertise are.
Okay, so my name is Aamir Jewani. I own and operate accounting, tax, and business consulting firm with the name Finaction. We operate in Canada, US, and UAE. So on one hand, we do provide these bookkeeping, accounting, tax, and advisory tax planning services in these respective countries to businesses as well as individuals. But at the same time, by virtue of working in these three countries, we are, well versed into complications that arise when people move from one of these countries to another, or from any other country for that matter, to these countries, or from these countries to any other countries. So that has over the years become our niche, which is cross-border tax, primarily with respect to Canada, US, and UAE. So either you are leaving this country or these countries, or you are coming back to one of these countries. That's where our expertise lie in terms of helping people managing that efficiently.
Right. I think for people coming into Canada, that might be an easier move from a tax standpoint, because especially if you're coming from, let's say, Saudi or Dubai, there is no tax there, right? So you will have to deal with a less amount of issues compared to if you're leaving Canada. And I know a lot of people who have either left or in process of leaving Canada. They have no idea about what will be the tax implications if they leave without doing anything. So a lot of people, I know that, and for sure I know that they have left Canada and they have not done anything with regards to how they're going to manage their taxes, or how they will deal with CRA when CRA finds out that they are not filing taxes and they have already exited the country. So let's talk about that. What are the common issues that you deal with people with regards to that kind of a move? Because I have done another podcast with my friend Barrows, but that was related to US move. Today, I want to focus on if people are leaving to Middle East, for example, where there is no major tax treaties between these countries, and if you are leaving Canada, then what are the most common issues that you face with those people who either are misinformed or they have not done their planning and they left Canada, and when they're coming back, what are the challenges that they're gonna face, when they deal with CRA?
Okay, so I think let's start with the first part which you mentioned, that when people are coming to Canada from Middle East, there are just one or two issues which come up which I usually have to deal with. One is obviously if they already have assets in rest of the world outside Canada, and they plan to retain those assets there, or I mean beyond stocks and all, if they have properties there, or anything else, real estate or business there, and now they are moving here, especially in these countries where there is no concept of personal tax. That's where we need some planning. And the second part is when, that's very common. People would come here, do a soft landing, they would go back, and then, they would come again after 2 or 3 years. So the real question comes up that at what point do they become a tax resident of Canada? Because IRCC definition versus CRA definition, we have to look at it in a two different perspective from immigration and tax. So these are two common areas where people need a consultation when it comes to coming to Canada, assuming they're coming for the first time. If they are the ones who are re-establishing their ties in Canada, let's suppose they left 10 years back and now they're coming, then that's a different kind of question, because we need to see, what they have now outside of Canada, what it was when they left, and document properly, so that eventually when they sell those properties, then capital gain can be calculated accurately. There are some strategies you can apply with respect to the timing, especially if you are open about your timing of moving back to Canada. There are some strategies which you can apply which can help you from tax perspective. So that's where, if they engage us earlier into that discussion before they actually move back, we can help on that part. So that's the simple part. That's aside. Now let's come to the more complex and more common part, which is kind of triggered by a reverse migration in many cases, where people who move from Middle East to Canada, we saw that very commonly in 2015, 16, 17, and now that that batch has kind of got their passport. Plus, on top of that, as you said, the conditions are not that good in Canada with respect to economy, so they want to move back, or maybe they are getting better opportunity of moving back, or maybe closer to home back in India and Pakistan, aging parents or stuff like that, and they want to move. So either way, that's a more common scenario. And in that scenario, the biggest misperception that I get to hear from people is that we did not live in Canada for 183 years, so 183 days in a year. So we are not really subject to taxes in Canada. Chapter closed. So technically, that's a misperception that if you spend less than 183 days in a year, then you don't need to do anything.
If you are an investor in the US, in Canada, or in Europe, and you are considering investing into Dubai real estate market, this video is for you, because we have a platform called Stake, which allows you to invest into the residential real estate market and start earning rental income right away without going through a lengthy documentation process or coming up with a heavy down payment. Stake is built upon the concept of crowdfunding. So it is democratizing the entire investment strategy and allows you to own a single unit of the entire investment portfolio. So you don't have to own the entire property, right? You can be part of the pool that can actually own a piece of property, a piece of real estate. So that allows you to start with as low as 2,000 dirhams, and you can slowly ramp up. So as you start investing into it, you can not only own a bit of real estate, but you also get a portion of the rental income on monthly basis. So it's a passive investment strategy, diversifying your portfolio from traditional North American or European markets into Dubai, which is hustling and bustling and growing very fast, and allows you to build your wealth over time. So don't delay. There is a link down there in the description. If you click on this, it will give you free 200 dirhams in your account right away to start with, and you can thank me later.
That's it. You are free and clear. That's not true, right? And that's where
See,
people get the major shock.
I was also under impression that if you're living less than 6 months, then you're not a tax resident in Canada. So you're saying that's incorrect.
Okay, that's partially incorrect. So the vice versa is true. I mean, if you have no ties with Canada, no citizenship, no residence, nothing, somehow you happen to be in this country physically, with some exceptions, for 183 days, you are tax resident of Canada,
Okay.
right? So staying more than 183 days does make you tax resident for that year. But if you are a citizen or a PR holder, and just because of the fact that you stayed less than 183 days doesn't make you non-resident. So
Okay.
yes, one side is true. If you remain there, you are a resident, no matter your legal status. But because you have passport, as in citizenship and PR card or PR card, and just because you stayed less than 183 days doesn't make you a non-resident. Yes, that is condition number one. but you have way more conditions to fulfill, not just 183 days,
Okay.
right?
That
So
means,
yeah.
if you are holding Canadian citizenship or you have, permanent residence card, it doesn't matter if you are living here for less than 183 days, you are actually liable for taxes here, right? You are actually a tax resident here.
Yes, so you are either a tax resident or you are a deemed tax resident in Canada
Okay.
if you have a passport and citizenship, and most important part, you did not cut your ties,
Okay.
right?
So we will touch
So,
upon,
yeah.
what does it mean by you did not cut your ties? So there could be a lot of things that falls under the category, right?
Yes. So basically, for a citizen or passport holder, it is more important to consider the ties than number of days in the first year,
Okay.
right? In the year you are emigrating.
Mm-hmm.
In the subsequent years, obviously, the number of days are important. If because you have become a non-resident now, obviously you should not be spending 183 days. So days are definitely a very important variable, but it is not the only variable for residents and citizens. So that
Okay.
is a very big misperception, we come across. Yeah, and everything kind of ties up with that. And then typical scenarios would depend on what kind of assets you have in Canada. A very common template is usually you stayed here for 5, 6, 10 years. You have got at least one property and now you're moving back. Obviously, you are not set, especially if you're moving to the Middle East. Most likely you won't be selling that property because home is back in Canada at some point in your life, maybe. So you want to retain that property. Now, the way rental property is treated for tax calculation and tax procedure purposes for a resident is very different from the way rental property is treated for tax calculation and tax procedure purposes for a non-resident. So that's where another big difference comes up.
Mm.
And just a heads up to all your listeners, if you are one of those who is planning to move out of the country, this is one thing where you have to act before year end. A lot of things with respect to becoming non-resident, with respect to dealing with CRA and doing in Canada when you're moving out, can be done once you have moved before your final tax return. But rental thing is something you have to kind of start complying as soon as you become non-resident. So that's where you have to really engage me or any other tax professional well ahead of time rather than after the year has passed. For example, somebody moves in September, December is gone, your next tax return is due in April. So if you reach out to me or any other tax professional in, let's say, March or February of 2026, that, okay, I became non-resident in September, and by the way, I had a rental property. What do I do about it? So that's too late. By now, you have already kind of violated some of the CRA's regulations, and that may lead to some penalties. So yeah, that's one area where you have to be really proactive if you are becoming non-resident.
Mm. So we will come back to the rental property, management. Especially if you're leaving Canada. Let's talk about the cutting the ties subject, because that is not really clear to a lot of people. And oftentimes people think cutting ties means you don't have to keep your family here, but that may not be the only thing, right? So let's talk about what does it mean by cutting your ties in Canada.
Okay, okay. So let's start conceptually. See, Canada is kind of a welfare state, not really welfare state, then there are a lot of social services, universal healthcare or government services that are available to you in lieu of paying taxes in lieu of being a resident, right? So when you want to become non-resident, doesn't mean you have to give up your passport, but at least you have to cut your ties. You should not be recipient of those government benefits, first of all, and secondly, you have to cut your ties. So when we say cut the ties, the first major tie is obviously your family. Family means your spouse and your dependents. If they are in Canada, you are in Middle East, you are still a deemed resident of Canada. No matter even if you spend a single day in Canada, you are a deemed resident of Canada because you have ties with someone living in Canada, right? Your family independence. So that's first criteria. Your family, they have to be out there. Second criteria is you cannot have a home in Canada. You can have an investment property. I mean, you can own a property, but that property has to be rented. It cannot be available for you as and when you return, right?
Okay.
So if you own a
So, for
house, you
example,
have to rent it.
if somebody is just going there, let's say on a short-term contract, and they know that they have to come back, so you're saying that you cannot leave that property empty.
Because then it's a matter of intention. Because when you are
Hmm.
declaring yourself non-resident, you are technically telling CRA that I'm going out for a foreseeable future, right? I don't have exact date of return with me. If I
Hmm.
have an exact date of return, okay, I'm going for a 5 year, sorry, for a 5 month um, short-term assignment to, let's say my company is sending me to Japan for a 5 month short-term assignment, then you are not becoming a non-resident. You are just going for a short-term trip. So that's why your intention is not to become non-resident. So that's why your house is empty.
Hmm.
Obviously, if you're going for 5 years, probably you might not keep it empty. But even if you are one of those lucky people who have, free and clear property, no debt, and you choose to, there are people, who might just want, okay, whenever I come here for 2 weeks, I don't want to get into hassle of Airbnb or hotel and this and that. So I'll keep this particular condo for me, and uh, but unfortunately, CRA has to draw a line. So your intention might well be to become a non-resident, and you would be fully a resident in other country, but somewhere CRA has to draw a line, right? And that's why that is an important criteria, that your house cannot be empty uh, while you are non-resident. Obviously, there can be practical situations that, and that's why it's not really black and white with CRA. There are some gray areas. There are some opportunities where CRA can consider facts which are beyond what is mentioned in their guidance. For example, you have a property, but and you got a job in Middle East. You moved out, and you try to rent it out, but the market is not good. What can you do? Or that property is in a area where, it's not really area where there are many people moving in and out and they need a rental. So that's another reason. You could have a cottage there. That is another reason. So yes, the CRA does give you, when you have those exceptional situations, CRA does give you an opportunity to present your case to them. And for that whole reason, we have a form which is called NR73, which is optional. But in situations like this, where you genuinely have an intention, but there is something which is just not falling in line with the guidance due to some exceptional reason beyond your control, you can discuss that with CRA through that form. But in a normal scenario, you cannot have your family here, which means the spouse and kids, your spouse and dependents. You cannot have a vacant home here. You cannot have a place here you can return to or ordinarily where you would live. The third thing is you cannot have a Canadian employer. You or your spouse cannot have a Canadian employer.
Financial education is very important for everybody, especially for the kids who are still at school. Because when they grow up and go into the professional lives, if they don't know how to manage their finances, that is going to be a disaster to begin with. I have just published an ebook for the kids aging between 10 and 16 years to understand how they can manage their finances. So when they grow up, they know exactly how to manage their personal finances, because I have broken it down at a very, very basic level. What is money? How can we save? How can we invest? What is debt? How can we use debt? What is credit card? And how we can set ourselves for the financial future when we go into our professional life. So if you are a parent looking for a very simple to use ebook for your kids, click the link below to order the copy for your kids, and let me know what you think about that. Let's get back to the video.
So if you work in a multinational company and your employer is sending you out to Singapore, and you are still on their T4, so then you cannot be a non-resident. But yes, if he sends out to Singapore and the Singaporean company hires you, and that's what they typically do for this very reason, that when you move out from one country to another country, intercompany transfer, usually you resign from this particular legal entity and you get hired by the another legal entity. So
Mm.
that is one of the reason why they do that, because in order to become non-resident, you should not have a Canadian employer, neither you nor your spouse. So that is another important criteria. Again, there
Right.
could be exceptions when you might have a small gig here where, like, I have a client who teaches one semester in one of the universities in Canada, but he is well rooted and settled in Middle East, right? And that teaching is his passion. So that is just like a very small portion of his overall income,
Mm.
right? Otherwise, he's living in UAE. He has everything in UAE, family there, job and everything. So yeah, so these could be the exceptions, but that's why I said that it is a question of intentions, right?
Right.
But don't use that intention as kind of your shield to justify everything, because at the end of the day, the final decision is made by CRA or the
Mm.
tax authority. So yeah, use that intention part wisely. So it's not really
Okay.
always black and white. You can use those exceptions.
Okay, let's move back to the property thing. So you're saying that you cannot leave the property vacant for sure if you want to become a non-resident. What if somebody wants to keep the property for future use?
Mhm.
Um,
Mhm.
how do they want to rent it out? Like, can they rent it out to one of their friends or their relatives? Like, how does it work?
The only thing with related party is that it has to be on a fair market value.
Okay.
So as long as you follow the market practice, but then again, the onus is on you to prove. CRA won't come to you and say that you are charging $1,000, it should be 3,000. They would say, okay, you have to prove. So just get the comparables.
Mm.
A lot of time it happens. If I'm moving out, I might
Yeah.
just give it to my, brother-in-law, sister-in-law, this and that. They might keep better care of the property rather than some random person. I don't trust them. Okay,
Right.
fair enough. But that has to be at a market value. So just keep
Yeah.
again, as I said, onus is on you. So keep the comparables and then, rent it out based on those comparables and use the same for your income tax purposes.
Yeah, the reason I was asking that question is because, as you know, in Ontario, or I think in pretty much across Canada, the laws for tenants are more um, friendly for tenants compared to landlords. So if you rent it out and then if you want to move back, it's not really easy to evict
Yeah.
the tenant. So a lot of landlords who um, want to keep the property, they try not to rent it out for that reason, unless that property was purchased solely because of the rental purposes. Then it's a different story. But if it's your own property, you would think twice or thrice before you rent it out, because once the tenant moved in, it's not really easy to evict the
Yeah,
tenant.
we
So
all have
yeah.
read those horror stories,
Yeah.
where, and that's true, that happens, around us, different people are doing it. So it's very
Yeah.
common. So, yeah, I understand that's a practical limitation for people. But yeah, that cannot be an excuse with CRA that I feel that tenant would just not move out when I have to come in. You have to take that chance.
Okay. So we talked about, and I think I heard somewhere that even if you're renting that property, there are some other
Mhm.
challenges with that as well. For example, you have to hire somebody who will collect the rents, and it has to be withheld with CRA, I think 25%, so something like that. Do you have that information as well?
Yeah. Okay. So that's where when I mentioned that, the tax calculation and procedure for rental property for a resident varies a lot from the non-resident. So that's what I meant. So when you are a non-resident, or when you are moving out, becoming non-resident, um, first of all, you have to, so there are two options with you. Either you don't hire any agent, hire or appoint. Doesn't have to be a paid person, could be any friend, relative, anybody. So either you don't have any agent, and just whatever rent you are getting, the gross rent before expenses, you have to pay 25% of that rent to government. The legal language says that the tenant has to pay, but honestly, CRA is not really bothered who is paying it as long as they are getting it. So you have to open a non-resident withholding account with CRA. You have to deposit 25% of your gross rent every month into that account. And then after year end, technically that's your final liability. You don't really have to file a tax return. But if you choose to do so, Then there's a little bit lengthy process where you need to get an NR4 for that. NR4 is just like a T4 slip for employment income. NR4 is a slip which shows that against this particular property or this non-resident withholding number, you have deposited X amount of tax for the rental income, right? So you will get that NR4 and then you will file that tax return, which is not a T1, which is section 216 return. So you will file that tax return, which is specifically for certain type of income, including rental. So you will file that return and you will say that, okay, my income was, let's say, 48,000, 4,000 per month. My expenses were 45,000 and my net income was 3,000, right? And at whatever tax rate that is, the tax applicable is $750. But what I have paid you over those 12 months is 25% gross, which is 12,000. So then you can claim, get a refund of that 11,000, whatever, 12,000
Okay.
minus 375. You can get it back. That's the standard way, default way. So if you're not doing anything else, the least you have to do is submit 20, open non-resident withholding account with CRA, submit 25% of the proceeds into that account at the end of year, get an NR4 and submit the tax return, you will get a refund. That's option
So
number one.
that contribution has to be on yearly basis or monthly basis?
Monthly basis, every month.
Okay.
So for January rent, you have to pay by 15th of February. For February rent, you have to pay 15th of March. And that's
Okay.
where I said that you need to reach out to me or any other professional at that very point, because if you come after 3 months, you have already accumulated penalties for last 2 months,
Oh
right?
wow. And those penalties are
So
severe? Like
usually no, not that big.
mm,
They are usually 10% of amount you have to pay.
as a
CRS
penalty?
penalty structure
Mm.
is a bit complex, but generally speaking, yeah. So if your rent is not a big amount, that is not going to be a big amount because that is certain percentage of that. So yeah, but again, that's a shock for some people because at least at this point in time, for most of the people, rental is not where they are making money, right?
Mm.
At least in terms of cash flow. So most of the that is again very common misperception. Oh, my rental is in a loss. I'm paying from my pocket. I don't have to pay any tax. I won't have any tax liability. Don't worry about it. But this penalty is not on tax liability. This penalty is on what you were supposed to pay.
Mm.
So because you were supposed to deposit 25% of the rent, no matter the year, the liability might be zero or minus or whatever, but
Yeah.
because you were supposed to pay 25%, the penalty will be applied on that amount, right? So that's the default way. Pay 20,
Mm.
open knowledge individual account, pay 25%, you are good, and at the year file the return, right?
Okay.
So that keeps things simple, but obviously that is a big dent on your cash flow. The another
Of course.
option is
Yeah.
what we
Yeah.
call,
Because you have to
yeah,
pay in advance, right? You can claim it afterwards, but
yes.
in order to comply, you have to pay all those 25% contribution in advance. So is it also same for the rental properties as well? Like if I have my primary residence and I also have a rental property, does the same
So
principle apply
technically,
on that?
when you leave the country, everything is
Mm.
a rental property.
Yeah.
Yeah. So yeah, for all the properties, wherever
Okay.
you have a rental income. Right?
Okay.
Yes, if your property is vacant for some reason, you are trying to rent it out and it's not rented, then obviously you don't have to. But
Mm.
otherwise, that's what you have to follow, right? So yeah, so that's the default way where you pay 25%. And as I said, that's a big dent on a cash flow. Um, and it's a big timing difference as well because see, if you become non-resident on 1st of January, for example, so you have to pay for all those 12 months every month.
Mm.
And the earliest you can file that tax return would be, you need to get an NR4 and then you would file it. Let's suppose that you file your return by 31st of January the next year, and eventually you get a refund in another month, so maybe 28th of February the next year. So from the first payment you make, there is still a difference of good 1 year before you get that money back. And again, the cycle continues because next year also you have to follow the same thing, right? So yeah, so that's one thing we have
Mm.
to be considerate about. The alternate option is, and that's where timing is way more important, that you can seek what is called NR6 approval from CRA, right? I'll come to the conditions, what are the requirements, but what that approval means, that you take an approval from CRA that I will pay 25% of the net amount. Still it is monthly, still it is on 15th of the subsequent month, but of the net amount. And again, and for most of the people, here in GTA or big metropolitan cities, that makes a big difference on what is 25% net versus gross, especially if it is a mortgage property. So, by the way, that's another misperception. When I say net of expenses, that is interest income. Sorry, that includes interest expense, property tax, insurance, repair, maintenance, condo fees, and all that, but not your principal portion of the mortgage. So sometimes people would think, okay, everything is, I'm paying more than what I'm getting, so I don't have to pay any tax. But part of that is principal, which does not go into that calculation. So obviously you might have to
Yeah,
pay. So anyway,
that's right.
NR6 is all about you take an approval that I want to pay net of my expenses, 25% of my net expenses. Sorry, my net income from the rental property. And so you take the approval. If you are given an approval, then 15th of every month, you will pay 25% of that net amount. And obviously that is a projected amount because you are telling in advance that approval has to be taken before you start doing it. So it cannot be retrospective, right? So
Okay.
obviously that is based on projected income and expenses. And that is the reason in that option, filing a tax return is must. In the first option
Mm.
where you are paying 25% of the gross, if you don't need a refund, you don't file any tax return, CRA is happy with it. They won't come after you because
And
you already gave
how
25% of the gross.
easy it is to get that approval to get 25% of the net value?
I mean, it's not a discretionary thing where CRA will say, yes, no, today I'm not in a mood. I'm saying it's not a visa
Mm.
approval that you may get
Okay.
it, you may not get it. You will get it. It's just
Okay.
a timing thing. Usually it takes at least a month, and especially in the beginning of the year, it takes 2, 3 months.
Mm.
The reason is it has to be done every year, right? So, for
Oh,
example,
okay.
if you
So
became
it's not like once done and forget about it. You have to
no,
do
no,
this
no,
every
no,
year.
no.
Okay.
No. So, for example,
Mm.
if you became non-resident in month of May, right? So you took approval, you took that approval sometime in May, or even you can ask for that approval. Let's suppose in April you got a job and you have to join in May, and you were living in a very demanding area, and by 10th of April you already had a tenant agreement signed. You can even apply for NR6 on 10th of April. You don't have to wait for May to start
Mm.
applying. So you can do that. So let's suppose you got that approval and now that property was rented, you were paying everything, everything is good. So you again have to apply for 2026. So normally for most of our clients that we know that they are non-resident and we are already doing that NR6 last year, we have done it. We just remind them sometime late November that okay, give us your projections for the next year so we can apply. So in December, there's a bulk of NR6 application which goes through CRA.
Sorry for the interruption, guys. Just wanted to let you know that I also offer one on one consulting calls to the individuals who are looking to discuss their financial planning, their investment strategies, their kids' education planning, their immigration moves, as well as the young professionals because I have been in the tech industry for almost 20 years. So I also offer one on one consulting calls to the young professionals who are looking to have their career development discussion with me and also personal branding as well. So if you are looking to have some sort of an expert opinion, there is a calendar link in the description below. Book a 30 minutes call with me and I will be more than happy to help you out.
So if you are and usually if you give by end of December, typically you will get it back by I would say January end or maybe 10th of February. So you are good for 15 February deadline for the January then. But if you are one of those non-residents who became non-resident on 18th of January, and before that you didn't know, you just surprisingly got a job and you moved, right? So obviously that is the time when the time lag is more than when you apply on, let's say, 31st of January, you might get it back maybe late March, early April. So that's why we see a delay, especially when you apply in first quarter. But people do get approvals. It's not that unless you meet the conditions, you will get an approval.
Mm.
And they are
Okay.
kind enough. If you miss something, they go by your original submission date,
Mm.
right? So it's not that if you miss something, then the counter starts again, and so
Okay.
they go by that. So they are reasonable in that terms. So you apply for that, and if you get approved, you pay 25% of the net rent, same way in a non-resident withholding account every month. At the end of the year, this time you must file your tax return. Again, and that is a Section 216 return. It's not your regular T1. You must file your tax return, and you should tell in the tax return the actual expenses. So the approval was based on projected, and throughout the year you paid based on projected. Now you will tell the actual expenses, and now the net tax liability, if that is more than what you have paid to CRA, then you will pay the difference without any penalty if you do in time.
Okay.
If that is less, then you will pay, you will get a refund. So just like
Okay.
regular taxes, if you deduct more in your income, in your salary, you get a refund. If you deduct less, you will have to pay. As long as you have already paid to CRA, I mean, usually for salary it's already calculated. But if you have other income and CRA asks you to pay the installment, and as long as you have paid the installment, you don't have any penalty on
Hmm.
on that extra amount you have to pay if you pay in time. So that's
Okay.
the way
And what
NR6 works.
and
Yeah.
what if somebody doesn't do that and they leave the property vacant? So what happens in that
Okay.
case?
Before that, let me mention the conditions because otherwise that kind of get skipped.
Okay.
So NR6, same way, you pay net, but you must file tax return. But there are some conditions.
Hmm.
First of all, you have to appoint an agent. It is a must. It's a not negotiable, right? Um, Agent could be anyone, your friend, your family, anyone who is a resident of Canada, right?
Okay.
Friend, family, parent, relative, co-worker, whatever you want, whoever you want to be an agent can be your agent. But you must appoint an agent because if you don't pay your taxes, CRA will go after them.
Oh,
So
after
it's a
them.
bit, it is
Wow.
a bit
That's a big
scary
liability
and
that
bit
somebody has to take it.
responsible,
Yeah.
big responsibility. So sometimes people are not really willing to do it. So when you decide to become non-resident and if you want to
Hmm.
be that go through NR6 route, first thing you should do is find a agent. We do provide that service professionally, but honestly, it is not one of those services I advertise a lot. If somebody, again, it's a responsibility for me, right? Yes, I will do it in a very professional way that we will debit your account, we'll pay to CRA, we'll keep a track. But again,
Hmm.
it's a big responsibility which I really don't
Yeah.
want to take unless somebody can do it themselves. So yeah, so first of all, you have to have an agent who is responsible for that. Agent needs to open what is called NRV account, non-resident withholding account, where the money would go, and that NRV is tagged to that particular property, right?
Hmm.
Okay, so you have to have an agent. You must file a tax return, right? And yeah, these are the conditions. You
Okay.
have to have an agent, and you must file
Hmm.
a tax return. Um, yeah, and it is based on projection, and then eventually, whatever, if it is refund or whatever it is, you have to pay. So agent has
Okay.
to be really careful. I mean, if you are becoming an agent, you have to be careful. You can trust that person, or if you are that person moving out, then you have to find someone who can trust you enough to become your agent. So that is
Hmm.
important for NR6. And most important, it is not retrospective. So it has to be at that time when
Before.
you,
Yeah.
yeah, or if you are not getting time or you are not able to find an agent, so you cannot just delay it. You have to pay 15% of gross for those months until you get approved for
Okay.
NR6.
Okay.
So yeah,
And so going back to my previous question, so what if somebody
yeah.
doesn't do all of these things? So what is the penalty?
Well, if they doesn't do anything, again, that's kind of like, when you are driving on 401, sometimes you are above 100 and you might not get caught. So yes, you might see
Hmm.
those situations, you might see people around you that who would say, oh, I moved in so and so here. Nothing happened to me. See, so yeah, that can happen.
Hmm.
Obviously, given the limited manpower of CRA, it is a possibility.
Yeah.
So yeah, but generally speaking, if you are not doing it, the problem is that so that different variation. There are one kind of people who assume that I have no liability because I am out of Canada, and they won't file any tax return. Obviously, that's sheer violation of your, not filing your tax return. CRA can have all kind of penalties on that. The second is you file your tax return, but you just file like you normally do when you are in Canada, which is you file your T1 and you would mention, that this is my rental income, these are my expenses, here's the tax, and you make that tax payment in April of next year.
Hmm.
I have seen situations where when it is first year, CRA has been a bit lenient and given them a notice that, okay, we are accepting it, but going forward, you need to file section 216 and you need to do withholding. Um,
So in that case,
the
if
third,
if
yeah,
that, if that person is not telling them that they are not in Canada anymore, so How does CRA finds out, like if the person has already moved and they're filing their taxes as if they were still in Canada? So how
Okay, so
does
tax return is
yeah,
based on self-assessment, right?
yeah.
That is the basic principle for all tax returns for most part of the world. It is based on self-assessment. You have to self-declare. If
Mm,
CRA find or tax authority finds out from any other source, then obviously they can come after you. But normally when you file your tax return, there's a question that on 31st of December, you were resident of which province. So in that list, you have list of province and territories plus an option for non-resident,
okay.
right?
So you have to
So plus
declare those.
there's,
Yeah.
and then it asks you for the date when you became non-resident. So assuming you are the person who does not want to lie to tax authority, then your tax return will tell that you have become non-resident. And now
Mm,
that you have a rental income in the tax return, let's suppose you say you became non-resident on 31st of October, and you also have a rental income. It could very much be a possibility that you had rental property until October and you sold it and you moved out. So yes, CRA cannot make one-to-one discretion in the first year, but obviously in the second year, they would know that if your status is non-resident and you have a rental income, then you are filing a wrong
mm,
return. So for the first year, they still give you that leverage sometimes. Again, don't quote me on that. It's CRA, it can change its mind. It's not a
mm,
written rule, it's just a courtesy they are doing. Their first year, they sometimes they would say, okay, you were supposed to do it, but you haven't done it. Going forward, please file. But sometimes they might come up with a penalty as well.
mm,
Especially so that if you try to do it in middle of the year, that's another problem because that CRA's tax section, the part of CRA which deals with income tax assessment, right? That's a different part of CRA. There's another part of CRA which deals with non-resident withholdings,
mm,
right? I haven't seen them to be that lenient. So, for example, you became non-resident on 1st of February. You did nothing until April or May, although the property was rented, and then you realize, oh no, I should do that. It's not correct. And I don't want to take the risk of having not doing anything till December, and then next year maybe I get a huge penalty. So let me correct it, right? And that's what most of the time happens because people are not by default want to avoid it. It's just that in the move they are so busy and it kind of slips through the cracks. So let's suppose you moved on 1st of February, and by the time you realize we should do something, it was end of April, and then you engage me or somebody else, and by the time you find an agent, you applied for NR6, everything happened, it was June. So on 15th of July, you made the first payment for the month of June, or maybe for the 6 months.
Are you feeling lost in the complexity of global economy and trying to understand how this is going to impact your investment portfolio? You are not alone, my friend. I have been through and I have learned the hard way, and I'm trying to converge all of my experience and learnings into a course that I just designed specifically for you. In this course, Mastering Macroeconomic Fundamentals for Investment Strategies, I'll show you how to decode the economic trends, navigate market cycles, and build smarter, adaptable investment strategies. You're going to learn, analyze key indicators like GDP, inflation, and yield curves, identify opportunities in commodities and crypto alike, and adjust your portfolio to thrive in any cycle. With real-world examples and actionable insight, this course will empower you to invest with confidence, no matter what the market is. Don't just react to the news, understand them. Enroll now and take control of your financial future today.
At that point, they can impose a penalty, and they do
Hmm.
impose a penalty. They don't give any leniency.
Okay.
For non-resident withholding, it's just like your payroll withholdings. They have a set way. If something is for January, it was supposed to come 15th February. If you pay on 16th of February, here is your penalty. If you pay on 15th of April, here is your penalty. So
Hmm.
that department goes by the rule. So there is no
Okay.
leniency, no courtesy, nothing. I mean, obviously they have to. Right?
Okay.
So yeah. So penalty can come in different ways depending on what route you choose. But again, why to take that risk, right? At the end of the day,
Yeah.
if they have given
Yeah.
an option for a grant, it's just that you have to do some paperwork, you have to find someone,
Hmm.
maybe spend some money. Um, just do it. Why to take the risk?
Yeah. Yeah. Oftentimes, actually, people don't have either time or they are not very well prepared for that. For example, I've seen some people got a job offer and within like a month they have to leave because the
Yeah.
employer is not waiting for them, right? So they want them to be there, like let's say by 10th of next month. So then they don't have time to kind of do all these planning and
Exactly.
they just leave, right? So that's why I was
Exactly.
asking, what if somebody doesn't do anything, then what's the penalty for that kind of person? So it's good to know that. Let's talk about the other assets. For example, if they have uh, tax sheltered accounts like RSPs and TFSA and RESPs, what happens to those accounts? Can they leave them as it is, or there's also some penalty that will be applied if you don't really close them, or don't treat them properly?
Okay, that's where Middle East is less complex than US because obviously when you go to US, the tax rules are different. So what is tax sheltered here may or
Hmm.
may not be tax sheltered. But for Middle East, there's no personal tax.
Right.
So obviously whatever you have in TFSA here or RSP here or whatever doesn't really affect anything for you in Middle East. In Canada, it will remain tax free. So whatever money is in your TFSA, RRSP, RESP will remain tax free. FHS is a new product, but I assume it will. But FHS has its
Hmm.
own rules because you have to draw it in certain amount of time, so that will still apply. But apart from that, whatever is in a tax sheltered account, if you become non-resident, that will remain tax sheltered. But first of all, you cannot contribute into it,
Yeah.
right?
Hmm.
Secondly, like TFSA, for the period you are non-resident, you that does not accumulate for your total what you call allowance that you can invest, right? So if I became
You
Canadian
won't get
resident
that
on,
allowance anymore. Yeah.
yeah. So those years are the ones where when you come back, you have to exclude those years when you're calculating how much you can invest in TFS.
Correct.
So yeah, you cannot contribute. It does not include in your allowance. And when you take out, TFSA is simple. It's tax free. It's your after tax money, so no problem. But when you take out RRSP, that is an income,
Hmm.
just like any other income, right? And they would withhold that money, uh, whichever broker or financial institution you are using, they will withhold that. So that's another thing. When you are moving out, if you have these kind of assets, you need to tell your financial institution that I am a non-resident. So
Okay.
once they know they are no, you are non-resident, again, onus is on you to tell them.
Hmm.
And then after that, you withdraw your RRSP, they would withhold that money. If you kind of doesn't align the dates, for example, you became non-resident on 10th of September, you wanted to take that money out, but just because you didn't have an account in Dubai, and then you said, okay, let me move there, open the account, and then I will take it out. So you became non-resident 10th of September. You took that money out on, let's say, 30th of September, and you know, yeah, and you tell your even at that time you didn't tell your financial institution, you thought it's not necessary. I'm taking money out. They are not there anymore. You don't tell them, or you tell them after 30 September, maybe in October. So obviously they haven't withhold as per the non-residents, right?
Hmm.
They do withhold whatever is default, but they won't withhold as per non-resident. Or if you have a dividend income coming, they wouldn't withhold as per non-resident. So again, the onus is on you to tell at the right time. Otherwise, there would be a penalty. So again, if you have to take the money out, um, it sometime it might be better to take out while you are a resident, depending on your tax bracket at that point in time. Sometimes it is better to take out after becoming non-resident.
Hmm.
Um, so that's a planning part which can be done. That's
Yeah.
where we can advise some strategies and help you to time it in a better way from tax perspective. Yeah. So you cannot contribute. There's a
Hmm.
huge penalty. Not huge, but it's 1% of the contribution amount per month.
If you
I have
over-contribute.
given that. No, if you contribute, you cannot contribute
Okay, yeah.
if you are
So,
not
yeah,
resident.
okay. Understand. So basically, your contribution limit is gone. And if you
But
ever contribute above that, then of course there will be penalty on that, right?
yeah, so
Um,
your
and
contribution
what
limit
if,
is zero essentially.
yeah, and what if somebody, like, you are in your working age, so you don't have to draw RSPs anymore, and you leave it as it is. You're not contributing it, but you let it grow while you are out of Canada. Is it allowed?
Yeah, yeah,
Yeah. Okay.
yeah.
And same goes with TFSA. So TFSA is tax free for capital gains. Whatever investment you have in TFSA, you're not contributing into it, but you have assets who are growing in its equity value. Then again,
Yeah,
it is still considered tax free, right? Okay.
yeah, yeah, yeah. Once
Okay.
you take it out, you cannot put it back. So that is the only thing you have to consider.
That's right. Yeah.
Yeah, and as I said, that 1% doesn't seem harmful enough, but sometimes it does. I've given that
Mm.
example in many different podcasts. I had a client for whom I filed those backdated tax returns for 12 years.
Oh my God. Yeah.
So
Then
maybe
unfortunate.
10 or 12, yeah, I don't
Yeah.
remember exactly. And she had already moved out to good, and she had a rental property. She filed for a few years, and then she kind of stopped filing it, or she kind of, missed the track. Then she asked me to file all the backdated rental property returns. So we
Mm.
did that, not knowing at that time that back in the 2011 or whenever was the first year she became non-resident, after becoming non-resident, somehow $1,000 were contributed into her TFS,
Mm.
right? So when we filed everything, this alerted CRA, okay, this person became non-resident back in 2011
Mm.
and 12 years back, and $1,000 means $100 per month penalty, 1% per month. So for 12 years, that became 14,000.
Oh my God. Yeah.
That
That's a lot.
harmless $1,000 became 14,000. She might
Yeah.
never have earned that big money out of that
Yeah.
$1,000 investment. So yeah. So sometimes if you forget, it keeps on building, and it may get alerted at a very later stage, right?
Mm.
So yeah. So these are the things. So you cannot contribute, and it can grow tax free. And then when you take it out for TFSA, no problem. For RRSP, that is an income. You have to pay tax on that.
Yeah. And oftentimes, people who are going into retirement or already retired, they actually go to Middle East or maybe in Southern Europe and they just live there. And if they draw RSP contributions, um, are they also considered non-resident? I believe so, yes. So in that case, what is the tax rate applied when they draw the RSP contributions? Oh, actually, the RSP payouts.
So withholding, most of the non-resident withholdings are subject to 25%, most of them.
Okay.
However, if you are, again, we are assuming it's Middle East and there's no tax, but if you are in US, there's a treaty. So some countries do have, I mean, Canada, UAE also does have a treaty, but there's no tax, so it doesn't matter. But
Mm.
some countries where they have a treaty, the tax rate, the withholding might be different. Or even if the institution is withholding 25%, you can, get it reduced or get a refund from CRA. So yeah, if you are in one of those countries, better to check what is the treaty rate for that income, and you can get a refund from CRA. So there's some
Mm.
income where you can get a refund if there is an excess withholding. So especially if you are in one of those situations, better to have a quick overview. And these days it's very easy. You have got ChatGPT and all that. Not that I'm endorsing that they are giving all the
Yeah.
right answers,
Yeah.
but
But it's a
at
very
least you can get
genuine
a
use
working
case,
knowledge.
right?
That's a basic factual question you are asking to ChatGPT. That
Yeah.
what is the treaty rate for retirement income between Canada and US? It would spit
Mm.
out that. I'm pretty
Yeah.
sure that would be a correct answer. Yes, it
Yeah.
cannot make some interpretation on the specific situation, but at least so yeah, better to find out if you are in one of those countries like UK, Netherlands, this and that, and you think there's a treaty, just check that.
Okay. Which is very, very genuine use case. A lot of people, they tend to, when they're retiring, they tend to move out to some nicer place where the weather is moderate. And if they are taking RSP payouts, then of course the tax will be different compared to what if they were living in Canada. So,
Yeah.
very, very genuine use case. So I think we have covered a lot, Amir. So thanks very much for first of all to spend time with us this morning. And for
Most
the audience
definitely.
who are watching this, now you understand it's not as simple as people think. So if you are planning to leave Canada or you are in process of leaving Canada, make sure you do proper planning. Otherwise, you will be handed a huge tax penalty from CRA if you don't, properly deal with that. So Amir is one of those expert in this field, and he deals with clients moving to US, moving to Dubai, Saudi, or people coming into Canada from those countries. So he is expert in terms of how he help out those clients. So please reach out to the email address which is in the description below if you want any consulting help, or if you want Ahmed to help you out to plan your tax strategies if you're leaving Canada. Reach out to us and I will connect you with Amir and his team. They are perfect and they have helped out a lot of my friends as well. So please reach out and let us know what you think about this podcast. Put your comments down below. Give us your feedback. And if you want us to cover some other topics, let us know. We will come back and cover that topic as well. Any last thoughts, Amir, before we wrap up?
Yeah, last thought would be, timing is everything. Think of you being a crypto investor, right? You have huge capital gains and eventually now you don't need to work. You are saying, okay, I will live rest of my life in Dubai. Um, Depending on when you actually become non-resident can define how much capital gain you have had. Oh, sorry, a very, very important point which we haven't discussed. So I'll just briefly touch upon it. When you are becoming non-resident, moving to another country, if you have capital gain, if you have unrealized capital gain on some of the investments, right, you may have to pay tax on that. Good part is those registered investment we discuss are not part of it. But if you have unregistered investment, if you have assets outside Canada, there may be some capital gains. So that's another place where you have to consider the timing and do proper planning.
Right. Yeah, I think that we missed that one. So that basically could be if you have a margin account, which is not registered account. Let's say
Yeah,
if you have crypto account, for example,
yeah.
and you had 100% capital gains on those assets, so you have to pay withholding tax before even selling it, right? So it
On the
would be
unrealized one.
yeah only yeah that's a very important thing that we missed. So yeah, for people who are having crypto fantasies here, and if you're leaving Canada, then you must know that you have to pay withholding tax before
Yeah,
without
or a
even
very
selling it.
no,
Yeah.
yeah, or a very common scenario that you had a property, you lived in Dubai, you had a property, you moved to Canada, you still retained that property. Now you're moving back to Dubai.
Hmm.
So that's where again this thing comes up that Canadian properties are okay. You don't have to pay tax on that, but foreign properties you have to. So which means that let's suppose when you were initially you went to Dubai, you bought the property, you moved to Canada, that property was let's suppose 500,000 dirham. Then you stayed in Canada for 5 years, and now that property is 700,000 dirhams, and now you're moving back. So that 200,000 is a taxable capital gain. So again,
Hmm.
for that kind of thing, it could be a big tax bill if you are not prepared for it. So yeah, that's where timing is everything.
Yeah, for sure, for sure. So thank again, Amir. So please, we will bring you again next time. And the audience, please let us know if you want us to cover some other topics regarding taxes. So let us know. We will cover that in our next episode. So thank you very much, and we will see you
Thank
next
you.
time.